if we're all following this rainbow to the pot of gold or the holy grail to retire and leave out into the sunset.
The bigger question is, how big's that pot have to get and how much are you willing to risk and invest to get your way to it? But at the same time, you can generate cash flow. You can build a practice that generates a meaningful cash flow stream that is just as sufficient and create your own pot of gold. It's not necessarily having the bag of gold handed to you, but if you pick up a gold coin every month and you put those gold coins in the right places, and you'll create a pot of gold on your own.
Welcome to Accounting High.
Introducing the star of our show,
Scotty and Alex Drost.
We're gonna have a problem here.
Oh, students, you are in for a treat today. I got my buddy from Michigan, Alex Drost. Alex, you and I knew each other way before Matthew Kidd was ever on this show, but Matt was the one who just interviewed me fairly recently for our students. He also was the one who suggested that I have you on fairly recently. You guys are pals there over in the Michigan, Detroit area. Is that right?
We are, and shout out to Matt right now. He's got a man cold going on, so we're having drinks later this week if he can get over it.
If he can get over his cold, what is he?
Yeah,
got the sniffles?
Exactly. Yeah.
All right. Well, dope. I might see him in a couple weeks too in Charlotte. But you and I are here today at Accounting High. We may not be sharing a drink, but we're going to be sharing an hour here and discussing some interesting things, some things that you consult on in the profession, in the industry. This is going to be more of a PE type conversation. We're going to sprinkle a lot of PE on here. Alex, you used to be an active CPA. You have a CPA license. Why don't you tell our students a little bit how you got into this profession here, how you became a CPA?
Well, Scotty, well, I appreciate you having me on today. And it's, Matt Kidd, it's funny to bring that up because I think I'll tie the whole story together where there's kind of a piece of that. So why I'm a CPA, how I became a CPA, and what led me here. I started in my undergrad, was set out to be an accountant. That was, I guess I don't have a strong why or a drive. I was business minded. I took some accounting classes in high school and said, accounting is something that sounds good, a CPA, being a CPA. And so I said, I'm going to go be a CPA. That was kind of my start off in running at it. Part of that was learning that you had to have 150 credit hours to sit for an exam. And so I dual majored in accounting and finance in my undergrad entirely to get the CPA license. Now, fast forward to today, I have never worked in what would be considered traditional public accounting. I did take and pass the CPA exam. I am licensed, or I have what's called a registered license status here in the state of Michigan, which just means that essentially I get out of taking my CPE, but I don't actively use my license. But the pathway of understanding and being a part of the accounting industry, I was a Becker rep when I was in undergrad, and then when I had graduated and kind of got into the workforce, got pretty involved in our state society here, which is where I met Matt Kidd, and where the two of us have become friends, and just really stayed active in and around the accounting space. But I was doing work in investment banking and in business consulting. What's interesting here, and we can tie this into our conversation, but I see the accounting world in kind of two different lights of partially understanding a little bit of that generic pathway, how and why do you get in there. But my professional experience has largely been in and around tangential professional service consulting style service, where leveraging my accounting knowledge and some of the baseline that I learned through my educational process has been important, but the actual work style is entirely different, far more finance focused, and that would have never happened if it wasn't for me having to take the extra credits to get the CPA exam to begin with. That was never part of the plan. That was the side plan to supplement getting the 150 credits.
So it's an accidental path that you ended up intermingling with a lot of accountants. You joined the state society. It was actually Randy Crabtree who introduced us years ago, another alumni from Accounting High, or the one who's been graced the halls around here at Accounting High. How did you two get connected?
Podcasting. some conversation somewhere. I honestly can't remember. I actually just saw Randy right before the holiday at the PE Summit in Chicago. We were talking, but I do remember that now. I remember when he connected us. That was a long time ago.
It was connection builders. There was something about
That's
connection
it.
builders that connected you guys, that brought you two together. That's a
Funny,
firm
man.
that you're still actively involved with. That's your firm, right? Connection builders.
It is, yeah. No, so I'll give a little of the story on that. So my when I started out a little over 5 years ago now, started primarily focused on business development, networking, training, connection builders. That was the kind of core thesis of it. Built some training resources and still have a couple of those active. But what happened is I was, and this is, I guess, the business lesson, you go to market. As I was going to market selling the BD training service, I was getting pulled into deeper strategy conversations in and around private equity, M&A, and which drew on a lot of my historical experience. And then it's evolved to where I'm at today doing consulting work around it. So I do a fair amount of networking. I spend a lot of time talking with folks and having conversations like this. And it's amazing what you can learn when you start hearing things from a lot of different perspectives. And that's, I think, a lot of where I find myself sitting today, in particular at the intersection of, what is the accounting in an advisory industry look like going forward, and what are some of those seismic shifts at play, in particular, where does private equity play into it? Some of that has to do with my professional experience and what I've done from a hands-on day-to-day work in previous careers. But another chunk of that has a lot to do with, as you network and spread kind of a broad set of individuals that you spend time talking with and having intelligent conversations with, you can learn a fair amount about where things are heading, what the challenges are, and start trying to piece together some of those solutions.
So that kind of led you to that path, right in the middle of the intersection of this private equity and accounting. It's fascinating. You just mentioned there was a conference just on private equity, and you were there. So I'd love to talk about first, what was the overall mood in the room of that conference? Why were people flocking to this location just to talk about private equity?
It's a good question. There was two sides of it. You had one side one caucus, if you will, was the investors that had capital, that knew they wanted to invest in the industry and were there hoping and trying to find a potential suitor for an investment. And then the other chunk of the group was, by far and large, folks, whether in a firm, part of a big firm, owner of a small firm, just an investor, a consultant, advisors, people that had maybe some play in and around it, or have done something, or are thinking about doing something, but they were really there just to learn. And so, to answer your question, the broad sentiment of the event was very much curiosity. Here to learn, here to understand, which I thought was fascinating. It was actually, it was 36 hours of nonstop back-to-back conversations, intelligent, smart conversations that were very thought-provoking in and around what does this all mean? Because it's happening so fast and so much has already happened that there's a lot of momentum that is unstoppable in the industry, and it's going to have broad-reaching effects. There's no doubt that we're in the early stages of where it's going, but we're going. Like, the game started, we're playing, and you're either paying attention to it or you're going to miss out on it.
We don't have the benefit of hindsight in this because it's still all very new, right?
Yes, very.
And what makes this new? Was there people outside money investing in accounting before this?
There has been some small investments, a couple trials. One of the most notable stories, if you look back, H&R Block, American Express, you can look up and read some of the stories around that. And there was some falling out there. RSM had some dynamics in and around that as well. We've heard of EY trying to spin off a group. There's been a series of thoughts around it. What's really changed is, if we look at, and we'll talk about why it changed in a second here, but if we look at what's really changed, if we go back to 2.5, 3 years ago, and we started seeing Eisner Ampner was done, or Cherry Becker, some of these are older investments that have played out. We started seeing a greater number of private equity investors that were looking to make investments, and all of a sudden, the rapid succession at which investments were made. Think about last year, the last 18 months, it was every couple of weeks, there was some type of announcement coming, right? And so that happened very quickly, where I think this is very different than in the past. Too much, too many to stop the momentum. It doesn't mean they're all going to work out perfect. It doesn't mean they're all going to look the same. It doesn't mean that there isn't more to come or more change. It does mean that this isn't one or two here or there, a couple of creative things. This is like 30 different players that in 20, 25 investments that are real investors that have real capital, tens of millions, hundreds of millions of dollars of equity capital at risk here. This is a real game. And just the sheer scope and complexity of that, I think, is inevitably going to reshape and reshift what the future of the market looks like.
Playing in this PE game, as we are going to call it now, because you said this is a real game, so now we're going to call it the PE game. Playing in this game, you're going to be playing with the big boys. Your area that you focus on, consultant for middle market, how would you describe the middle market?
In terms of the middle market, what I see is I look at the industry and some of what's changing is, think about advisory services, right? We hear about a lot of firms talking about advisory and where advisory plays a role. We see that as being a major area of growth for the industry. And the primary buyer for that are organizations that are typically what we would consider middle market. In that, there's a lot of definitions for that, but somewhere a business whose revenue is on the low end, 20, 30, 50 million, and on the high end, $1 billion, 2 billion, depending on who's defining it. The core of that middle market, what's really fascinating about it is that if we actually look at, and I've got a presentation I do in this where I slice up the individual number of businesses that exist within each of those revenue buckets, and if they're privately held or if they're publicly traded. And about 75-80% of individual businesses in the US are measured somewhere between that 20 to 50-ish million in revenue to about $1 billion privately held. And that's the client base that has a very fast evolving set of needs that's far greater than just the audit and tax work that historically has been bread and butter. There's a far greater scale of advisory type services that are available to servicing those businesses. And then on top of that, that middle market is where most of private equity makes investments. So totally outside of the accounting space, just private equity as an investment class invests a lot into that middle market space because it's typically where you can aggregate businesses and where you can create real value by getting to much larger scale and investing in certain operational efficiencies, scale, infrastructure to build better businesses. Not too dissimilar to what they're going to do in the accounting space, but that's what private equity does as a whole in the middle market. Who do they hire to do all of those? When private equity goes and does that, not any private equity firm, they go and do operational transformation, they hire consultants and advisors. And that's where there is a demand, I believe we're going to see a continued outsized demand growth for the advisory, middle market advisory services. And that's a entire market segment that if you look at where private equity is invested, we've got an entire class of investors that are looking to build assets, the firms that will service that space. That isn't the only space, but that's one growing space. That's a little bit of where I see a little around my niche personally. But there's the broader industry. There are other changes at play driving that PE investment.
So they want more firms doing this advisory type work. They want this happening at accounting firms. They want them to start doing this work, and they're transforming them to become these advisors. Is that right?
No, let's okay, so I'm going to put myself in the investor seat. What I want is a strong return on my money. That's about it.
Yep.
I am going to measure that based on the return that I need to return to my investors as a satisfactory benchmarking of my capital. And I'm going to measure that against the risk inherent in those investments. And I'm going to then look for industries and businesses that have the right set of factors at play that then makes sense for this transformation to happen. And so the transformation is already happening. Well before PE, advisory services has been a growing area of interest, and you hear a lot of firms talking about that's an area to grow is advisory services.
Absolutely.
That the PE element of it, where I see private equity, and this is potentially an area of interest, is there's a continued demand to grow that. But what it comes down to is, if I want to diversify my service offerings so I can have a broad set of advisory-like services, one of the fastest ways to do that, to accomplish that well, is through an acquisitive strategy. M&A activity, buying smaller consulting and advisory practices. If we look at the PE for investments that have been done, Cherry, Becker, Aprios are two really good examples. They're acquiring some smaller accounting firms, but they're acquiring billing and coding, ERP implementation, business consulting services. Fahrenheit Advisors just got bought by, I think it was Smith & Co. or Smith & Howard. We're seeing these advisory add-ons to expand the breadth of services.
Would you say these are like advisory boutiques?
Very much.
Buying?
Very much. And they're adding them onto that existing base. And what it's allowing is for a broader, more diversified set of service offerings to the client base. Because you're already the trusted advisor. You already are in, and you are working with these middle market organizations. So how do you land and expand the service offerings that go in there? And accounting firms are very well positioned to be the cornerstone of that, of building out around that. And
You're
again,
already
that's
touching a lot of their finances.
and that's happening in accounting, regardless of private equity. But if you look at not all, but a number of the private equity investments play right around that space, and where we see that growth or where we see that acquisition strategy is going after these boutique consulting firms to continue to expand those service lines.
And what we did start to see early on is also some separation with the compliance in these firms, splitting
Absolutely.
off separate entities to service the compliance, to stick with all those old laws that we have in the system, stick with anything that's holding them back. Let's just split that off, and then now we have a new business and a new sandbox to play in.
It's the alternative practice structure is what it's often referred to as. But what it really comes down to is, it's from a compliance standpoint, separating out where there are limitations around who you can serve and how the governance behind that works. Beyond that, the advisory side is far less limiting, and that is the area of growth. Now, there's arguments to be made that advisory has a heck of a lot more variability to it. It's not as steady Eddie and consistent as some of the audit and compliance work tends to be. But I also see, and so there's the argument of, if you separate the businesses, are you creating a different business model that has very different characteristics? Maybe. What I see, though, is still going back to the growth area is the advisory services. That is where do I expand different offerings? And that is where you're going to see the consistent consolidation of what could be a small player today might all of a sudden be part of a much bigger organization because of that being added into from an M&A standpoint.
Let's talk about some of the other parts of the market here. Let's not the middle market. What do you call the part of the market that maybe my firm is in?
What's interesting is when we look at it, it's the lower end of the market, and not it could be small, medium businesses is probably the correct term, SMBs. What's important, though, is it's less about the size. Does have a factor here. What it has to do with is, who are you serving? Who's your client, and what are you doing for them? Right? Because let's talk client accounting services, fractional bookkeeping, fractional controllership, fractional CFOing. CFOing probably gets a little more competitive with some of the middle market stuff, but that the bookkeeping CAS type businesses, which if built right, if developed well, or even tax prep businesses, if built and developed well, can be very lucrative practices that the accounting firms, the established accounting firms, are going to have a challenging time spinning any of those up from the ground up. And so the part of the market, the serving SMBs in developing some of these niche specialty type firms, size will have somewhat of an effect on that. But I also think that you're going to see plenty of opportunity for both the explosion or continued emergence of the $2 to $3 million firms, where you essentially have a single owner who is effectively financially independent, and they work in it some, maybe they don't, but they've got a nice business that it's really hard to compete with. You're kind of just in your own niche. And I think you're going to see some of those people that take that same business and go to the 15, 20, $30 million mark on their own over the next decade, or maybe even in less time, depending on how they grow, that are going to become really appealing businesses to eventually sell into maybe a bigger firm or to sell to private equity. But in the short term or in the near term, building some really nice niche businesses around that, serving that end of the market.
Building that boutique that could be acquired and used and help transform a larger firm.
Very much.
Continuing on the conversation we had on the show fairly recently, dismantling pyramid schemes, that's sort of what's happening here. They're being dismantled in some ways by the private equity, and they're splitting them apart, but they're also acquiring some of these boutique firms to help change it from within. That's what happened with Summit CPAs.
Excellent example. Yep.
Into Anders. And
Yep.
That's another thing that's happening. It's happening with, we had a couple of ascension firms. I don't know what to call them. We've had a couple of their firms that have been acquired on the show as well. HD Growth Partners and another one of the $10 million firms, Steve Hoffman. And again, continuing that conversation of how do you think these smaller firms are being impacted by these conversations?
If I'm a smaller firm, a single owner, say sub $2 million, I've probably had a good number of people reach out to me in one way or another. I have no need to do anything because I'm in total control. My biggest fear would be that whoever I'm competing against becomes a heck of a lot more efficient because they've reinvested in their business, partnered with private equity, or some transformation that makes it harder to compete in that space. The caveat, I'd say, where I see, if I'm a $5, $7, $10 million firm and I'm a partner within that, and I've got 3, 4, 5 partners right now, I think that story looks a lot different, because that space, that sustainability of that model is going to be greatly challenged based on how private equity is reshaping the industry. And now that doesn't mean you have to go make a private equity deal or sell the firm. What it does mean is firm owners have to start looking at their businesses like businesses, and instead of a job that they get paid an income for coming to work in, which is part of what they do, but like real business owners. And I'll give you really the great example of this. And take accounting out. Let's just think about business for a minute today. And I'm going to tell you, I've got 2 different businesses that compete in relatively the same industry, selling relatively the same products with relatively the same labor pool and customer base. And one reinvests 5% of its earnings into funding growth, and one reinvests 15% of its earnings into funding growth. Which business is going to achieve greater growth and have greater value on a 10-year timeline? Most likely the one with greater investment.
Sure.
Right?
Most likely.
Most likely.
You would assume.
It's assuming safe investment, smart investment decision making, and that those investments ultimately yield a return. They are most likely worth more. In the accounting space, in this, one of the big challenges has been as a partner model, particularly when you get up to that 10-ish million, 15, 20 million, depending on the dynamics of the firm, you start to really need to make some real investments in growing the business. And I think one of your podcasts I was listening to earlier was talking about this idea of, someone has to be the CEO. Someone has to be the ops person. Someone has to go and generate revenue. And not everyone wears a couple of different hats and everyone's part of every decision. Rather, we have roles, we've invested in corporate infrastructure that runs the business. When you have to start making those investments in partnership models, and this isn't exclusive to accounting, this is how most partnership models operate, particularly here in the US. At the end of the year, we have X dollars in profit. We're going to divide that up. And maybe we're smart about how we divide it up. Maybe we just divide it by X number of people that have their hand in the pot. But all that money's going out the door, and it's very challenging to retain those earnings to reinvest in things because it's seen as a zero-sum game, and it's seen far more as a risk where I'd rather just have those dollars out. And even you even hesitant, around if one invests more than the other, who's going to be farther? Well, that depends if it was good investments, right?
Yep.
Maybe I just want the capital myself, and I don't really want to play this game because I think I can do it better myself. And that's exactly some of the fundamental challenges in that space. And this is where I say private equity. I don't want to give too much credit to private equity here in doing this. But what investors do is they look at a business from an investment standpoint and they say, well, if these are good investments to make and I can analyze that and determine if it's a good investment, then I'm going to make that investment because it's a good investment. As long as I have a fair and effective cost of capital to justify that investment. And that's a different risk parameter. It's a different willingness to reinvest in a business. And that's where, you talk about the SMB service market, especially for individuals like yourself that are smaller firm owners that are typically single owner or maybe two partners, but like there's a pretty tight decision-making control. You can build a really cool business around that and be willing to make some of those reinvestments because you can see it so much more clearly and you feel so much more in control of making those decisions, and that can launch a business and really create opportunity here. I think private equity can help or is helping some firms do that. I think firms can also figure it on their own. Again, I don't think the consulting work I do is by no means anywhere near just go sell to private equity, but let's figure out how to prop yourself up, position yourself so maybe you do that, or let's figure out what we can do to stay competitive. And what I go back to, this comes back down to really institutionalizing the way the business is run, where you have real executives in real roles driving the business. You're making real investment decisions and funding future growth. You're looking strategically at what customer base you're developing. And that's a much different way of running a firm than what most $10 to $20 million firms, $30 million firms are ran today. Now, again, the opportunity is for those folks that want to break the mold right now and build some interesting businesses around that.
And is that where the pot of gold lies then? Is that where, if we're all following this rainbow to the pot of gold, or if we're all following this path toward the Holy Grail, is that deal going to be a lot more lucrative than somebody just purchasing your firm independently versus a private equity?
So what you're describing is enterprise value, is to have a business that has enterprise value and ultimately equity value, net equity value, but you're trying to create real value in the operating business. In terms of selling, is there a pot of gold? Is there a wealth creation opportunity there? Absolutely, no question. The bigger question is, how big's that pot have to get and how much are you willing to risk and invest to get your way to it? But the liquidity exit opportunities are certainly great. At the same time, you can generate cash flow. You can build a practice that generates a meaningful cash flow stream that is just as sufficient and create your own pot of gold. It's not necessarily having the bag of gold handed to you, but if you pick up a gold coin every month and you put those gold coins in the right places, and you'll create a pot of gold on your own, right? I mean, it's now at the end of the day, some form of succession, wanting to exit the business, sooner or later, you're going to have to. You got to figure out what that looks like. I think for most entrepreneurial type folks, at least from my own experience, there's a timeline and everything. It sounds fun. I love doing it for a while, but at some point it becomes monotonous. At some point it gets to a point where you don't enjoy the role, the responsibility you have in it anymore, and you have to find something different to do with it. One of the challenges, and this is not specific to accounting, this is across the economy right now, you have this term called the silver tsunami. This is the boomers, the retirement of the boomers who own a lot of small businesses, accounting firms included. And as you are getting near retirement age, you eventually you need to exit out of it, and you want to capture your value. One of the worst things you can do, and again, not accounting specific, but one of the worst things you can do if you are a seller of a business is say, I want to sell and I'd like to be done immediately, or I'd like to be done as soon as possible, because there's no transition, you're not creating any value to who that buyer is, and so you're more likely than not to be limited in who the buyer is, and you're more likely than not to receive less value for it. And so under that view, if I know that sooner or later I'm going to want to retire or do something different, I should be thinking 3, 5, 7 years ahead and starting to say, okay, well, if that's on my radar, maybe I should start thinking today about how do I move towards that and try to find what the right opportunity looks like. I do believe that every business owner, you either have a business that is designed purely for your own cash flow and just to employ yourself, creating a paycheck for yourself, and that's your only intent of it for the foreseeable future, which is fine. But if you are at that point of saying at some point I'm thinking of an exit, I would very much be focused on how do I really position this thing for value. And candidly, I would recommend any business owner manage their business from that standpoint of how much is this worth and how do I increase that value. The only reason I kind of put a caveat around that is for some folks, and particularly in certain accounting businesses and in service type businesses, you can create something that you're generating nice cash flow off of, and you have no need to really go sell it. You don't have to be looking directly for an exit immediately. That, I think, is an interesting part of the opportunity in the marketplace right now, because I know a lot of folks, you make a certain amount of money, and outside of your own boredom or your own greed, you're probably just fine until for as long as you want to continue doing it.
So that's the pathway that people can choose. There's different pathways, right. Alternative pathways, alternative firm structures, forks in the road. There could be pathways paved in gold where you may not be investing a lot of extra profit. Maybe you're not even investing that 5% in growth because your pathway is already paved in gold and it's very profitable. Or you can chase that vapor of a promise that there's a huge pot of gold at the end of it, but you're going to have to invest a lot of your money. So you're not going to be stepping on gold coins along the way. Every gold coin you find is going back into investing into growth.
Where I think the accounting industry is going to be interesting here, particularly around servicing some of the SMB work, is there are ample opportunities for service providers to build the $1 to $3 million business that is largely single owner and generates that as you said, you're getting those gold coins along the way. When you move to a $10 million firm with 4 partners, I don't think that's possible anymore. I don't believe that you can do that. You can keep collecting those gold coins, but at some point you're going to also want to get paid for the gold box that you think's at the end. And if you forgot to actually leave any coins in the box, who the hell wants to buy it from you? So unless you just want to step out of it, and we have this standard retirement model that is typical, and
it's not a pot of any gold anymore. It's a box of gold.
Well, it's a box, and I forgot to put anything in it. I forgot to put most of it in there because I was collecting those coins along the way. And that's, I think, a little bit of some of the shift that we're seeing. And now, there's a whole nother tangent we could go down around. Some of the changes are the labor force augmentation. We talked about middle market service line offerings, but the way we can service clients, the margin that can be made, the willingness and ability of clients to use technology coupled with some type of professional service to ultimately run their businesses. That's evolved a lot in the last 10 years, and that's evolving fast. Those types of things usually take some type of investment, and money is absolutely part of it. Time, focus, energy, thoughtfulness is usually one of the other really big investments that most firms, partnership models, really struggle to be able to do. Because everyone's so worried about the client service, everyone's so worried about the billables, and we're all so worried about making sure we maintain our artificially high pay, our annual compensation instead of burdening the business by paying someone to not service clients and be the executive that runs and leads certain elements of it, right? The idea of having a true CEO, the idea of paying a sales or BD person or a growth person, right? Those investments in corporate infrastructure that need to be made. That's a meaningful difference that I think we'll see unfold in the industry over the next handful of years.
That would require sacrifice. And some
Correct.
people who have been accustomed to a certain type of lifestyle and a certain cost of living may not desire that type of sacrifice at that point in time.
No question. No, there's some, and I don't want to pull into the exact data behind it, but if you look at, anyone can pull out the average compensation benchmarkings for partners over the last handful of years. And we've seen a pretty material spike up in income for partners in the last 5 years, 7 years. A lot of that was attributable to we're starting to see certain technology investments that are able to create some more efficiencies. So our labor costs are under control better. We're getting a little more scale in our operating. And think about some of the smaller firms where you have people that are managing just an absurd amount of client workflow because they've invested in technology to automate or to streamline huge chunks of it, right? There's certain areas where we've created some scale. All of the industry started to get some scale from technology. Some firms in certain pockets more than others. But in addition to that, we've also seen pricing of what we can charge for services go up quite a bit in the last handful of years. Some of that there was some mismatch in the market of availability and in supply and what the ultimate demand was for it. But some of that is that business has gotten pretty complex and a lot of businesses need certain services done and things done in the right way. And there's just a greater aperture, I think, today of what's available out there to service and the way you can build around some of those models that just didn't necessarily exist. Think about QuickBooks Online and doing a CAS type model or a bookkeeping type model. Go back 7-10 years ago, and how many of your clients were on some type of a cloud-based accounting software that you could even do that with to begin with, right? So many elements that have really shifted and are having that transformation is having a broad ripple effect across the accounting industry.
Yeah, we're seeing all those ripples as we speak now. It's all been intersecting in this one spot. So, if private equity isn't something to ignore, absolutely not, because it's helping create an alternative model that could be the model, and we could start seeing some more norms take place where we're creating a new type of scheme. It may not be a pyramid scheme, it may be some other shape and size. We don't quite know what that looks like yet. A lot of people say it's more of a diamond shape, right? You don't have as many people on the bottom because technology is taking the place of a lot of the labor that was happening more toward the bottom. What are some other shifts that you're seeing in this whole market that's seismic?
One of the big questions I have is, what does it look like for the young 30s to young 40s professional today in accounting? And I use that age range as, call it maybe strike zone millennial. I see that professional came in to this industry, this profession at a very different time, in a very different pathway, and has witnessed some of the shifting, but was also not far enough along on that pathway to really reap some of the huge benefits that certain firm owners have, or to be well positioned to be in a top executive role necessarily to really drive some of that. And so they're the ones that I think are going to be faced with some of the greatest challenges or decisions to make. And what I can see, take a big example that I'm sure we've all heard about, BDO turning to an ESOP. And this is not PE, but this is one of the transformations unfolding in the industry right now. But this exact example I'm talking through, you could think of the same thing for a manager at BDO when they did the ESOP transaction, or a manager at...
And for our students, ESOP, Employee Stock Option Plan.
Ownership
right?
plan.
Ownership plan.
Ownership in this case. Essentially, it's a way of creating owners amongst every employee within the company. Correct. Or a PE back, someone who was at Eisner Ampner when they had their initial investment. When you think about a manager in either of those firms, when those transformations happen, you start to say, okay, well, how did they think about it? And we saw some of this with people who were what I would call out of the money. They were senior, but they weren't quite at the point that really did well in some type of a transaction. You saw some of them leave. If you follow any professionals at these firms, especially that level, we saw a lot of what I'll call musical chairs. I jumped from one firm to another firm, and it's because something happened that I felt I got screwed. I got left out in something. And so that's natural when PE or when industries have transformations. You see that type of stuff. The bigger question is what happens to someone who wasn't quite in the place to be like, you know what, Pound's saying I'm done, I'm going to go leave, but who's also stepping back and saying, is this model work for me? And I think, and this is where I very much believe it's an open-ended question that we do not know the answer to yet, and it will take time to really tell us what the outcome is. Some professionals are going to look at that and be like, wow, this opens up a smarter way of running a business, more opportunity for me, potential wealth creation. I really like this. This is great for me. And then some are going to say, this just made everything worse. I want it to be I want it to be a partner and an owner or something. I don't want to work for a corporate. I think we already have some of that, right? That's always happened. You've always had fallout, as particularly big four, but even down beyond that, you have folks that jump out of firms and go into either a smaller firm or go start their own. That's going to continue to happen. I think it's just a much more of a wild card of what that looks like. I think there's far more variables at play today than in particular that are in play in just starting to really shift around and will take the next 4 to 7, 10 years to really watch them play out. And that's going to, I think, have a huge impact on what the lower end, the smaller firm market looks like, because of, do some of those people step out and go do their own? Do some of those people decide that, hey, this model doesn't work, and at a greater velocity than what's already happening in present day?
The generation that benefits the most from this is the strike zone Gen Z. As they become of age to start off, they could start off on their own. There's enough resources. And millennials benefit from this too, because it's the case right now. It's easier now than ever to start your own little niche firm. It could be for magicians. It could be for anything.
The difference of Zs versus millennials in that is millennials have 2 kids, a car, a mortgage, and the risk.
They have a higher risk.
Boom. There you go. Jumping and starting or going down that pathway is extremely risky. Entrepreneurialism can be extremely risky. I think some of it can be de-risked. Dark Horse is a great example of ways that try to de-risk certain things. I think we'll see a lot more of that, or more opportunities. But even opportunities to go join some of these firms where you get in pretty early and can make a damn good living doing it and play a meaningful role, but are still not in that the bigger firm or traditional firm culture and mentality. But the millennials have a great opportunity at it if they're well capitalized, or they have a huge risk tolerance that they can go take it.
It's the risk tolerance, because how many of them can say, okay, I've got, this much in the bank. I've got kids that I need to support. Now I'm going to quit and go on my own.
Yep.
And
it's hard.
Then you're going to have to go a couple of years of dipping into your pockets just to build that client base too. Some people can go out and leave and go become contractors and work, kind of on their own, but it's not as easy. So that's a very good point you make. Gen Zs are probably standing to benefit the most. And we'll see what the next generation, the alphas, have to deal with because of the Gen Zs, whatever they create. We'll see what happens there.
The only thing the Gen Zs are lacking, and this makes me sound like I feel like I'm my parents or the next generation. They're lacking experience, wisdom. I don't think that's a barrier to entry. I just think
No, the experience and the wisdom's there. It's in ChatGPT right now for them.
That's what I think that you can find the right resources as long as you're smart and thoughtful, methodical about how you approach the market and are specific in what you're trying to build. I think it's much easier to go out and tackle it. The barriers to going and starting a business today like this are so much lower than they like. Think about 10, 15 years ago, how much more challenging it would be to start that where compared to where we are in today's world.
So we're completely redefining what it takes to go out and start and build one of these firms that eventually becomes middle market, right? So that person out there, that Gen Zer that's out and that finds that perfect niche and they know how to invest in their own growth, and then they start hiring, and then they have a remote firm. They're hiring people all over the country. Now, before you know it, they become, in their 30s, 40s, and they've got a $10 million remote-based firm, right?
Yep.
We're seeing it happen.
We're seeing some people that have already done it. I guess from the ones I know, I think are all millennials with us, but I see more and more of that popping up.
Yeah. I think I'm using Brandon Hall as an example, and he's the younger age, but I'm thinking about his because fully remote, about 10 million, or he's on his way there, and he's built it all kind of on his own. He might be an elder millennial, but
he's a millennial.
He's a millennial too. Yeah, he's an elder millennial though. Yeah, that's dope. Done. So I love this conversation, and I love where we've left it off at. But as we all know, there is no definite path for anybody. Everybody's a snowflake. Everybody's got a different path that they can go on. If you choose your path made of golden bricks, path paved with gold, that's beautiful. That's for you. And if you plan to sacrifice and you want to reinvest in your company and build it and grow it, that's for you too. Anything that you decide to do, all of these paths is the path that you're supposed to be on. Whatever path you choose, you got to make a choice though, right? You can't just be trying to straddle a couple different paths.
That's the hardest part. That's the entrepreneurial challenge, right?
Absolutely. You got to pick something to stick to it. Give our students, our entrepreneurial accountants, a little bit of advice coming from Mr. Drost here.
My number one advice is someone who's looking to go down this right now, really look at technology and the way you can use technology to run a smarter business. And not just automation, but just how do you use technology, workflow management, your knowledge management, and ultimately to streamline and build something to really leverage the infrastructure, because that is not only particularly if you are younger and are familiar with technology, you've grown up in and around technology, not only do you have a greater ability to understand it and navigate it, but the challenge of organizations, more sizable organizations, technology adoption is a really hard thing to do. So trying to go in and implement a forward-thinking approach to using technology into a 100-person firm is an extremely challenging task to undertake. Trying to do it to a 10-person firm or a 5-person or even smaller, that it's much easier to do, much easier, because you control it. And I think there's a lot to be said about leaning into that and embracing that as a true competitive differentiator in how you build a business.
That's why some of these larger firms have transformational officers or chief technology or chief this, because change management is a huge burden for them. They are embedded in their old ways. And for us, newer gen or smaller firms, we can be a lot more agile, more nimble, let's say.
Very, very much so. I think you're a Notion user, right?
Yes.
You've used Notion. I've got a Notion tab open right now. I live in Notion. I could not in any way imagine rolling Notion out to a 100-person accounting firm. Just like broadly across it. Now you could in small pockets, executive team, and slowly over time, they would just trying to get certain the folks that I know within certain firms. There is absolutely no way you would get adoption behind it. I think you could build a hell of a business managing client advisory services in leveraging a tool like a Notion. Notion's just an example of many different tools that are out there. But I think there's some real advantages to using tools like that to run and build a business that set you leaps and bounds ahead competitively than what you're seeing in more established organizations today.
Well, I write all my raps in Notion, so I launched and built a rap career out of that. There we go. Peace out. Class dismissed. Accounting.
AKR.